Hi, I'm Mark Persano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. We have a lot of things to go over within the data because there were some interesting numbers that we want to go through. So segment one, there's draws across all refined products. We want to talk about, is that something that's going to continue? Are imports going to increase? Are exports going to decrease? Because we had some differing data points when you look at the import side. And again, remember, there's always that timing delay of when it actually shows up in some of the numbers, which is why we've heard it multiple times from multiple different people, all about the adjustment factor. And again, there is that timing delay. So that's something that we want to look at. And if you remember, we were saying that demand was going to get boosted, especially gasoline demand, but we had a big overshoot in some of the numbers. But it's important to look at it seasonally because 4 of the last 6 years had something very similar at this exact time. And typically there is that pivot from, if you're not running winter gasoline, if you're not running summer gasoline yet, you have to. So there's that big push to get that into the system. You also have that preparation that's beginning from Memorial Day driving. So again, there's a lot of some of these pieces that come into it. Distillate had a nice bounce, but one of the things that we're seeing is that a lot of things are starting to slow down again when you look at it going back through the supply chain. So we're going to talk about that. And then we want to look at Russian exports versus production, because the headlines are showing that, Russia announced and achieved their production cut, but exports actually held steady and rose. And that's exactly what we've been saying, is that they had to cut production because they were overwhelming their coastal systems in terms of exports. There's only so many tanks they have, slips they have. So they had to cut, but it didn't mean that they were going to reduce exports. And that's something that we want to look at. And then we want to go through refined product storage, because there was a massive build in Fujairah. For those that have been watching us, we've been saying a build was going to come. This one is just much bigger than what we expected. And we want to see if there was a bit of a makeup. And is that something that's going to continue? So with that being said, we're going to jump right into to some of the numbers. Total oil and product stockpiles surplus narrowed from 30.3 to 29.5. Again, fairly normal when you look at the holistic picture. That's something that will come closer to the 2017 to 2019-22 range. Total crude stocks land floating. The surplus widened from 20 to 20.6. So again, very stable. There's actually been a lot more crude that has moved from floating into transit. So that number will come down a bit and likely touch that average before it kind of bounces back up. Because remember, the transit is that timing of when it's in motion, when it then goes back into storage, and whether it goes floating or gets pulled directly onshore. Total oil product stockpiles, the surplus narrowed from 10.3 to 8.9. That's something that is going to come down a bit, just because we did get some draws from the middle distillate front, but light distillate and heavy resid had some sizable bounces. So, it'll come down, and then we expect it to bounce back up and stay above that underlying average. Now, when you look at total land storage, the deficit narrowed from 27.6 to 25.8. That's something that is fairly going to stay fairly stable. The question is always going to be, because we have so much crude in transit, really at a record. The question is, when does it show up? When does it get pulled in? And there's a significant amount of flow coming from into China, but we want to look at some of that Chinese data, because typically this is the peak of, or I should say the first week of May is the peak of buying for China, and then it diminishes. There's usually another little bump in the end of June, and then it really kind of flatlines until you get towards the end of August, really the first week of September, because any crude that is purchased now won't be turned into product until the end of the summer. So they've already done a lot of their summer driving pieces. So that's a key piece that we want to talk about and look at when we're discussing storage levels. Total floating storage, the surplus now from 27.4 to 5.6. West of Suez, the deficit, the flip to deficit from positive 3.4 to minus 4.9. That was driven because West Africa had a small bump, but still just small. Europe had a big drop, which again accounted for that. And then east of Suez, the surplus narrowed from 14.2 to 3.1. We did get some Middle Eastern crude moving through, so that accounted for the drop. But overall, when you look at the total level, there was a sizable switch from floating into transit, which is something that we want to look at, especially in segment 3. Crude stocks had a build. It built 2.95 million barrels. When you take in the aggregate with the SPR, it was a build of 30,000 barrels. Because remember, there's a little bit left in terms of what was planned for 2023 SPR sales. Remember, those sales were planned back in 2013, so it's not like it was something extraordinary. When you look at the builds in general, the Pad 1 getting closer to normal when you look at the 5-year. The Midwest continues to be light versus the 5-year, but still seeing the builds. Some of that could get hit with some of the forest fires in Canada that could disrupt some of the flows. So far, it hasn't been a huge piece in terms of some of the volumes, but that's something that could change, which is why we're watching it closely. Pad 3 had a draw of 1.12 million, but it's still 4.6 million above the 5-year. And that draw was significantly created because there was a massive drop in Pad 3 imports. But again, there's a matter of timing in terms of those imports. But that's something that we did see. And then when you look at Pad 3, Pad 4, Pad 5, things were fairly stable. And that's something that we don't see adjusting. When you look at crude oil inventory, excluding SPR, we're just tracking 2019, something that we've been talking about. Right now, you typically kind of get a flat line in terms of builds in the crude region, just because you have that back and forth as you start to get refiners starting to gear up for summer, for the summer push. You have some of those imports, exports kind of bouncing back and forth. So again, we expect this to track closer to 2019, not really fully to that level, and then start to flatline, but you can see it's still fairly normal versus historics. And then when you look at this, it's following 2018 fairly closely on the commercial side, including oil and products. The product side is going to be interesting. We want to talk about gasoline because we've started to see an acceleration of imports from Europe into the U.S. This past week was at a 3-week high, and we see that growing, but it's not fully reflected in the imports. So, and it's not fully reflected in the gasoline storage numbers, and that's that timing delay that we want to talk about in the next segment. Crude oil inventories in Pad 3, again, moving very closely to 2021, but as you can see, it started to curve sooner, not too much of an adjustment in general. We think that that's going to be fairly stable and following that trend as we go towards the end of the summer. When you look at Cushing had a small build. When you look at the build, it was a build of 400,000 barrels. As we've been saying, it should actually kind of trend a bit higher. Not to say it's going to be a huge surge, but the trend is going to be to the upside. When you look at runs had a small increase of 30 basis points to 91% utilization rates, which, as we've been saying, is right where they should be, where we think it's going to be. Based on the fact of where we are, it'll likely have one more bump, and then you'll have that slowdown from Memorial Day, and then you really start to see the refiners ramp up, and that's where we'll likely get to about 94-95% utilization rates, likely not touching that 97, just because we do think some headwinds are going to come into play, which is going to keep them from reaching that peak. And as you can see here, staying towards the high end, but it's still fairly normal for this time of year. There's been stronger, there's been weaker. Realistically, we're just going to continue to track. You can see that there's typically a big spike and then a drop. This, I think, is going to be smaller spike, smaller drop, and then we'll have that continuous move, which you can see continues to grind higher until you get into July. And then you start to see things kind of flatline through August and then drop off as we head into September. So again, nothing too crazy there. Imports, Big drop of 842,000 barrels a day. That's 736,000 below the 5-year. And as you can see, it was all driven by Pad 3. Pad 3 had a massive drop of 780,000 barrels a day, 821,000 below the 5-year. Again, there's a lot of timing in that. There's a lot of this, when did the refiners ramp up? It was that ahead of some of the imports hitting. So again, that we will get a big bounce in Pad 3. Pad 2 continues to be at an elevated level. As the forest fires adjust, that could move a bit lower. But as you can see, it was really Pad 3, which we do see reversing. And this just puts it into context of just how far that dropped, setting a new seasonally adjusted record low for 2023. But again, there will be that snapback and put us back within the lower end of that cloud. Pad 2 following the seasonal trend, but you can see at an elevated level. That's something that we think persists, unless obviously the forest fires. But right now, that's something that we see continuing. When you look at implied demand, this is where, so as we were saying, the 8.6, 8.7 is kind of where we thought things were going to be. Tom agrees with us. Gas Buddy was at about 8.78 million barrels a day for last week. So the 9.3 very much could be timing. There could be some lower numbers than others, just to kind of make this up because a lot of front loading in some of the buying. But again, there was still a good number regardless. So the question is going to be just how far does it reverse down? Does it reverse to 8.4, 8.5? Does it reverse back to about 8.6? And that's going to be the different bouncing back and forth. Distillate had an increase of 163,000 barrels a day to about just over 4 million. That's something that it doesn't go up or down in a straight line. It's just going to go sideways. It's just, as we've been talking about, we think it's going to underwhelm and underperform versus some of the 5-year. Kerosene had a nice bounce of 378,000 barrels a day, went from 1.54 to 1.92. There's a lot of this prerequisite for getting some of that jet fuel ahead of the Memorial Day push, which then again accounts for that start of driving, the start of vacation starting to pick up. So sometimes you have that pull through and then it'll drop back off. We still hold to that 1.45, 1.55. As we get into summer, we'll move that up. And instead of it being at 1.45, it'll likely be at 1.5 to about 1.65. And then as we go into that peak, it'll be that 1.55 to 1.65. So we will get that shift up. It's just going to take time to get there. Propylene had a big drop of 651,000 barrels, a drop of 486,000 below the 5-year. That's something that, again, is when you look at chems, when you look at their margins getting hit hard, we're now fully in spring. We're not getting heating kicking on. So again, that's going to put some headwinds, but it's also going to support exports because we're going to be very much advantaged on a pricing level. This gasoline implied demand kind of shows you that we typically get a bounce. And when you look at some of those bounces, and that you can see it was in 2019, 2018, 2017, 2016. So you do get a bounce that happens right about now. So seasonally speaking, this is normal. So we will get a pullback as we've gotten a pullback in all of the other years when you had that bounce. Sometimes you don't get a pullback right away. It kind of maintains that level into Memorial Day. Then you get a drop. It all depends on how the gas stations have been buying. And this is something, because demand has been a bit weaker, the buying doesn't have to be as continuous. So we should see this nice spike and then a drop off back into the range that we've been highlighting. So then when you look at days of crude supply, very normal, nothing too crazy here. Gasoline storage, again, continuing to trend lower. We're still trending pretty close to where we were in 2022. The question is going to be, when do we get that big reflection of European imports? And that's something that is more of a timing delay. You obviously had the help of that accelerated gas station purchasing, which helped pull this down. So, imports are still elevated. That's something that we see trending higher over the next few weeks. So that's why we keep talking about how we're going to get something that's going to look similar to 2019, that white line. Not to say that we're going to have this surge, but you're going to all of a sudden get these like 2-3 weeks of sizable builds, which will likely come after Memorial Day, and then you'll kind of see that movement. But those are things that we're going to talk about as we continue to look at them. Jet, again, having that nice drop down right within the average. And then when we look at the curve, your slight backwardation, you're kind of waffling back and forth. There isn't too much to say one way or the other. You can see that crude pricing has come down. For those that have been following us, we think we stay within a range bound. We had a call today with one of our clients. When you look at Brent, we probably stay between 76 and 78. If we go to the downside is probably 74. We don't really see 78 getting broken at this point, just because of where that demand cycle is. And one of the things that we just see is that demand is diminishing, not so much in the U.S. to a degree, but abroad, and that's going to shrink some of that upside. But one of the things that we've also said is this isn't going to be a collapse in pricing. It's going to be kind of like a step down in pricing, because the question is always going to be, when does OPEC step in again? Do they step in again? The UAE came out and said that they don't see a reason for a cut in the near term, but they've kind of left it open where they said, well, we're going to have to evaluate that medium term. So not taking it off the table, which is going to be something to watch, which we'll obviously be tracking. And then when you look at floating storage in the Gulf, just bouncing slightly. So it's just, again, some of that timing delay that we've talked about with imports, exports, where does storage go? And this is something where we do see floating storage edging higher, not an aggressive number, still staying at the lower end, because you'll see some of that get moved right in right away. But that's obviously something that we'll be paying attention to. So that's what we have for you on the kind of the holistic view. In the next segment, we're going to go deeper into the refined product side and where do we see things going from here as we really ramp, get prepared for Memorial Day, and then what that spending is going to look like as we go into the summer months.